Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video blog, this is the second video in a short series that I'm doing all about investor education. So if you watched yesterday's video, I talked about mutual funds. More specifically, I talked about why many mutual funds fail to beat their underlying benchmark index. I also talked a little bit about a trend that's been happening for the past 10 years or so, where more and more money has been flowing out of these active-based mutual funds and investments into passive index-based investments, either through mutual funds or through ETFs. So what I wanted to do here in today's video is I wanted to talk a little bit more about what I think is probably the most popular of these benchmark indexes that people sometimes invest in, the S&P 500. More specifically, I want to talk a little bit about what people are actually owning if they buy into the S&P 500, because I think a lot of people may not fully understand what it is they own if they're buying into an S&P 500 index. So first of all, the S&P 500 is what is referred to as a market-weighted index. And what that means is that the largest stocks within that index, or the stocks with the biggest market capitalization, are going to be where most of the money is going to go within that index. So when we look at this, and we look at the 500 stocks that make up the index, we quickly realize that it's very top-heavy. So we look at the top 3 stocks. It accounts for about 10% of all the money that's in the S&P 500. Currently, those top 3 stocks are Amazon, Microsoft, and Apple. So 3 technology stocks make up 10% of the portfolio. When we look at the top 10 stocks in the portfolio, it accounts for about 20% of all the money that's in the S&P. 50 stocks account for about 50% of the S&P 500. And when we get to 150 stocks, we now have about 75% of all the money that's in the S&P 500 is in just those top 150 names. So you can imagine that when we look at the bottom part of that list, the 350 stocks that are at the bottom, those stocks could be going up a lot or going down a lot, and they're still not going to have nearly the kind of impact as the stocks at the top of the list in terms of what impact that's going to have on the performance. So one of the reasons why I wanted to illustrate this is, first of all, I think a lot of people don't really understand how that money is distributed. But I also believe that there's some inherent risks with the way the S&P 500 is modeled here, and the fact that so much of that money is going into those top companies. So one of the things, again, I talked about in the last video was I talked about money flowing out of active-based mutual funds and flowing into passive investments like the S&P 500. So as that happens, anytime somebody adds money to the S&P 500, it gets disproportionately invested in those top stocks, those top 50 stocks or those top 150 companies. And in my opinion, I think that artificially inflates those prices and makes some of those prices a little bit unrealistic. So one of the ways that we can tell how expensive a stock is to look at something called the price to earnings ratio. Now, price to earnings tells us, again, how expensive that stock is relative to how much money it's going to make, and it's probably one of the best value measurements that we have out there to determine how expensive a stock is. When we look at those top 10 stocks, just as an example, we learn that those top 10 stocks have a price to earnings ratio of 43. And by historical measures, that's pretty high, because when we look at the entire basket of 500 stocks, we actually see that the entire basket actually has a price to earnings ratio of just under 18. So those top 10 stocks are trading for over 2 times the valuation of the basket as a whole. And this is not the first time we've seen this. And this is something that as more and more money goes into the index, and maybe as more and more money comes out of other investments, it's artificially, again, inflating those prices. And it's creating kind of what I refer to as a self-fulfilling prophecy. More money goes into those top stocks, pushing those stocks up a little bit higher. It entices more people to get into it because they're seeing the performance of the index, and they're selling other stocks that may have more reasonable valuations and other factors that may be important. So we've seen this a couple times in history. Probably the most prominent recent times we've seen this is in early 2000, right before the tech bubble burst. We saw the S&P 500 balloon up to about 40% of the S&P was in technology stocks right before that whole meltdown occurred, and technology stocks obviously were one of the hardest hit areas of the S&P 500. We also saw it in 2008, right before the worst part of the financial meltdown. We saw the S&P balloon up once again, this time to about 40% of the portfolio was in financial stocks right before the financial meltdown, and the hardest hit area of the S&P was again financial stocks. So unfortunately, as this cycle goes, it will continue to balloon up these stocks that are at the top end of the list, and in my opinion, I think it carries a decent amount of risk. And at some point, we may see a bubble bursting here with this as people realize that those stocks at the top are not worth those crazy valuations. So anyway, I wanted to make this quick video. I hope that makes sense. I hope it kind of outlines some of the risks that may be there with the S&P index fund. So if you own an index fund like the S&P or you're thinking about buying one, I hope this video helps. Tomorrow's video, I'm going to get into a little bit more detail on active versus passive investing. I'm going to talk a little bit about our philosophies on that, and that's one of the heated debates that's kind of going on right now on Wall Street. So I'll have some good insight on that. Again, if you're watching this video any place other than our blog at moneyevolution.com, head over there, check it out. We've got other great videos and articles. We also have a great free resources section that you can check out as well. So thanks, and I'll see everyone back here tomorrow in my next video.